So now we're going to get to our investing topic of the week. And we were going to phrase it one way, but I decided to phrase it another. Because Gerry had an idea, and I said, Gerry, I can do better than that. So the question is, it's investing because it's going to lead to on some investing avenues. But what do I do with all my cash, Gerry? So this is going to cover a potentially wide range of things, 30,000 foot view. And the first place to start is it's something that can kind of be thought of as near cash, depending on what kind of bond it is. But what's a bond?
A bond is an IOU.
There you go. Okay, next segment. All right, next segment.
It is. It's simply an agreement to, if you're the one that's borrowing the money, so you're the issuer of a bond. You're issuing let me rephrase that. If you're the one that's borrowing the money, the lender is issuing you the funds, and you're giving back to them a certificate that tells them that you owe them. They give you $500, and you're writing a note that says, I owe you $500 plus an agreed upon interest payable every 6 months, let's say, with a termination date or a due date of 5 years. And on that 5th year, I'm going to pay whatever interest I owe and the money back. That's a bond. And it can be issued by corporations. It can be issued by municipalities. It can be issued by the federal government. It's called treasury bonds, treasury notes, treasury bills. And that's just a function of the maturity. A bond is a maturity over 10 years. A note is 1 to 10 years. And a bill is less than a year. Leading to what should you do with your cash? Well, assuming this is cash, we're setting aside investment now. This is just the cash portion. If you used my savings and investment plan, it's the half that you're not putting into the long-term investment. You're not putting into your stock mutual fund or whatever. Or for that matter, it could be, well, let's just keep it simple. It's not what you're investing, quote unquote. That should be put in something that is invested in short-term bonds, which are short-term IOUs like treasury bills, which today it's really the first era since, 90s era. Certainly, 90s, where the difference between what you can get at the bank and what you can get in, say, a money market mutual fund, one which invests in short-term notes, short-term being less than a year. In fact, I believe by definition, the average maturity in any money market mutual fund by regulation is 270 days.
That's what I understand as well.
So it's rare. It's very liquid. And you're, in today's market, you're getting 4.5%. Now, that's not going to last. It changes literally every day with whatever current interest rates are doing. We all know, and we've talked at length about, the Fed has been raising interest rates, and that's directly affected short-term rates on short-term notes like treasury bills that are 3 months, 6 months, 9 months, a year. But for now, you can take advantage of getting that rather than leaving it in the bank. And I think if you're even getting paid in a checking account, which is rare, or even savings accounts at banks are a fraction of the money market rate. So we're at a period similar to where we were, like in the 80s when money market mutual funds became very popular because they were paying significantly more during that. In the 70s, it really started in the 70s when they were paying considerably more than what a bank account was getting. So we're nothing like what that was in the 70s, by the way. I think I remember money market rates getting to like 17 and 18%. Again, it didn't last, but it was there for a while. And rather than have your money earning virtually zero in a bank, you buy a money market mutual fund, and it's liquid. And frankly, it's largely what grew. I believe Merrill Lynch was the first company to do the money market checking account tied to an actual money market fund, where you could have your checking account set up where it was earning those kinds of rates, and be accessible by check. The cash management account, the CMA account, from Merrill was revolutionary in that way. And then everybody, they all came up with them. And actually now, they're not allowing that anymore. You can't use the mutual fund, money market mutual fund as a check writing. They all figured that out, and they created all their little bank deposit things, which you can write the check off the bank deposit, and it's back to getting a fraction. If you want to buy a mutual fund, a money market mutual fund that gets the good rate of return, and it's like the difference between 1/3% and 4.5% or 5% right now. You have to physically ask your broker to make a trade to buy the money market mutual fund. It's still very liquid, but you can't write a check off of it anymore.
It used to be, it was recently in my intimate experience with a discount brokerage that money that's just cash sitting in these accounts would be invested in the money market fund. And now
Right.
you've got to opt in by just, either online or making a call and saying, I want to buy $10,000 of this
Right.
money market fund. And it's their little way of, it's not a high hurdle, mind you, but they put in a little hurdle so they're not, giving away money the same.
It's a big enough hurdle because, and why did they do that? For all of you folks that think you're getting free trades at all these brokerage firms, guess again, that's how they get paid. So they figured that out. But you can still, assuming it's savings that's not needed to have checks written off of it, and so they've kind of gone backwards a little bit and made you do more legwork than they used to. So some of the innovation has gone away.
Well,
but
it's proof that what Thomas Sowell said is true. There are no solutions, only trade-offs. And with these things, you're getting a lot of free services from discount brokerages, but you have to have your head on a swivel. And I know for the brokerage I'm most familiar with, they knew they were going to take some flack for doing this, but they just said, look, we make a lot of our money off interest. About 1/3 of their money is made off of interest, and they're going to do this. And if investors want to crow about it, they can, but they're getting there. At this time, the trades weren't free yet, but they were pretty close to it. So
and everybody has done it now.
Everyone's done it now.
Discount or not.
Yep. You've got to have your head on a swivel. You've got to know how the people you work with are making money. And so it's not hard to buy a purchased money fund or a money market fund and get a much higher rate of return on your money as opposed to 0.35% versus 5.35%. But you've got to be aware, and you've got to take a few steps and take ownership. It's also worth noting that we talked about what to do with cash, and we related it to bonds. There are some bonds that are not appropriate for cash or near cash uses, like high yield bonds, junk bonds.
The longer term maturities, as well as higher risk, say corporate notes or bonds. But keeping it simple, most money market funds are not playing in that. They simply aren't. And I mean, virtually 100% of money market mutual funds are not in that realm. They're just paying, similar to what any T-bill or very short-term, high-quality corporate note would pay.
And we should say that we've framed this segment, what to do with cash. A CD is another option, but generally speaking, I think the CDs require you to get to agree with the money for a specific period of time. For most people, the slightly lower interest rate you get on a money market mutual fund is worth the flexibility. So,
and a CD is really just another form of IOU. It's just an IOU to a bank, and they're actually a little less flexible. They have these brokered CDs which you can't sell, but generally speaking, the CDs are a little harder to get out of unless they're maturing.
Correct.
The only thing, and so a T-bill or a T-bill is probably the better route. Frankly, I think now it's not that big of a differential in rate. And one thing that does make sense right now is if you're not going to use the money, you're certain you're not going to use the money for a year or 6 months, is that you may want to lock that up right now, because it looks like the next move in interest rates, as we've said already, I think on the last podcast, I think the next move in interest rates is going to be down. And it could be rapid, and it could be sooner than most people are thinking. So it's not a bad time to be locking some things up on a little bit longer term basis, assuming you don't need that money anytime soon.
That is one mark in favor of the CDs, because you are locking in that rate.
Although I might add, especially if it's a T-bill and you're buying a year and we're right on the interest rates, you'll be able to sell it if you needed the money and make a little bit of money, because as rates go down, those even a 1-year bill will have a little increase.
All right. So that covers it on what to do with your cash. And I just said, all right, again. But my Matthew McConaughey impersonation continues.
No, you are not Matthew McConaughey.
No, I'm not. Gerry, do you have anything that you want to say in closing?
No.
All right. So let's end it there. I think this is episode 81. Thanks for joining us. Check us out on YouTube. If you're listening to our podcast via iTunes or something like that, you can go see us if you want to. I don't know why you want to, but you can. It's certainly an option there. And taylorfrigon.invest on Instagram, and of course, taylorfrigon.com if you want to find out more about our firm and what we do. And if you want to look up our mutual fund, it's TFCGX, Taylor Frigon Core Growth Fund. Until next week, I'm Doug.
I'm Gerry.
And I hope to see you again on the Long Only podcast. Thank you for joining us.